Okay, hope you're all well. I've decided, well, I was going to try and record this session, but I really couldn't be bothered with all of the faff of having to edit it and upload it and all that kind of nonsense. So I just thought, you know what? Let's just do it live. It's fine. So, okay, so let's just jump in. It seems like we've seen a nice push to the upside from about the 30th of December. We've seen this, move to the upside, which has been not really good strong volume, if we're honest. It's just been quite static volume, but still we've had a push. Now we did get some news obviously from the Fed's unemployment. If I'm honest, I think it was probably pricing in the fact that we are ready for a dump to the downside because, realistically, I always say this, but if all that people are doing is selling, then the market maker's job is to provide liquidity, so they've got to try to get better fair value. So they're always going to try and push against the narrative. They're always going to try and push price the opposite way to favour a better price for when eventually we do see a sell off. So always got to keep that in mind. Now, just analysing the charts a little bit, understanding a little bit about what we think might happen. I mean, for those that are veterans of the channel and have been following me and are in the Discord, I like to use the kind of Elliott wave. So, just as a recap, what we think and what is a really fair idea is that this is your first impulsive wave to the downside, okay, and then we have a corrective wave, which is your wave two. We then have a wave three, obviously a wave four, and then somewhere whatever wave 4 or 5 will play out. We'll analyze that maybe later on, but for now, it's just analyzing where wave two might come. Now, if you remember what we originally assumed, so back to when the data was kind of up to this point, kind of still into December, we were mapping out our ABC pattern, which is your corrective pattern. We had assumed A would be here. This would be B, and then we were anticipating where the C wave was going to be. Now, anytime you're doing technical analysis, right, you always have to always replan. If things start to change, the structure changes, you start to see a different dynamic in the way the candles are performing and the price action, then you just have to rebase. Now, what's still clear to me is this A move. What's not so clear on this one is obviously B. So what we can do is actually take B to the next low, which was here, which is on the 30th of December. And now we're trying to figure out where this C wave will be. Now, just some kind of guidelines. We anticipate that C will have to break above your A for us to signify that we've had a nice clear motive move to the downside for your wave one. We've finally finished our ABC correction, and now we can start to move down for our impulsive wave to the downside. And that's how it plays out, and that's what we're that's what we're anticipating. The problem we've had is, if we let's take this move. Let's look at the volume profile from the whole of this activity since the FTX fallout. And we just do that by simply taking, the the end candle to the after. You don't really want to include all of this because it's counter to the trend, but you want to kind of maybe go somewhere around there. And what this paints is a significant picture. We know that this 16800 has been a really sticky area, and you can see on the chart there 16828 is your point of control. It's where most volume is being traded. You've got the value area high, which again we'll come back to in a short while when we're doing some more analysis. Right at your 17180. We have our value area low right at that 16,419. So that's the low of that whole area. So we'll go ahead and take that off the chart for now, but just something to keep in mind. It's an interesting. It provides us some interesting areas in terms of, our range for the entire move. Now, another thing that's quite key to notice is this whole area here. You can see it hasn't really caused us it's actually caused us a lot of problems, but you can see if we take this move we've had, this was the move initially. We breached it once, twice, 3 times here, 4, and then we're kind of in this area. So usually what happens is if you keep on going for an area and it doesn't break, normally on your first move, you come back and retest, second move, third move, and then you get a rejection. You can see the rejection here. Now, because we came back up and tested a third and a fourth and now a fifth, I'm anticipating that we are going to break this area. Usually, the more times you come and retest an area, the higher the likelihood of you finally getting through that area. Now, realistically, because we're swing trading and we're on a longer time frame, and we're using the macroeconomic picture and the way formation is gathering pace in terms of Elliott wave theory and stuff like that, I'm confident in the move to the downside is going to be a fairly decent move to the downside. And again, I'm just using Elliott waves initially just to kind of determine that. However, what we need to determine is how far do we move up before we get that move to the downside, and that's what we want to figure out. So I'm just gonna like what I always do. I always like to use Fibonacci retracements, but then I like to look at confluence around those key areas to anticipate where that might be. So we're going to take let's just put the magnet tool on. We're going to take the top here to the low, and this gives us a frame of reference to work from, right? So we've got the reason we're finding this such a tough area is right at that 382, right at the 1740 area. It's a really, really tough area to break through, and clearly the Fibonacci 382 is really showing respect. Then you've got your 0.5 at 17294, and then we've got our golden pocket a little bit further up around the kind of 17600 area. So just these are going to be key areas. However the price gets respected, they're going to be key areas when if price retraces that far up. Now usually you want to try and see it come to take your 0.5, and then that's traditionally thought of as ticking the box. Now it's time to move down to wave 3 of your Elliott wave. So what confluence have we got around these key areas or in and around this area? Well, we can start with some daily levels. We always like to map out our daily levels. These are key turning points at a daily level where you see a transitional change from move to the downside or move to the upside. So we'll look a little bit messy, but we're kind of just looking at areas where we've got key daily levels. Now we don't have any key daily levels, so we have one here at the 1752. Remember, this is where price is at the moment. We had a little bit of a push to the upside, but not more than a wet fart. But we've got a key daily level at this 17109, so I think that's going to be a really key area that we need to match. Now realistically, what you can tend to see, and a lot of the time, what bulls are trying to do is to push the price up, but the bears can quite happily step in at really key points to fulfill a structure that they want to see. Now, as I say, that could be the ABC pattern playing out, and then therefore your 2 and your 3 could just be here right at that daily level, right? So that's one level of confluence just at this daily level here. I'm going to take the daily level off now because the next daily level above that is in your golden pocket area, which is right up at that 17600 move. What else have we got in terms of weekly? So what we're trying to favor really is your 0.5. Do we have any confluence around here? So at the weekly, again, right at that daily. So let me just see where the daily is there. So you've got a daily and a weekly, two really strong points in the chart right at that 1700. So 17,100. So you've got your daily at 17,109 and you've got your weekly at 17,096. So that's going to be a really, really important part of the chart where you want to see, where we expect to see at least some sort of a strong reaction. So usually what you can anticipate is a liquidity grab, push to the upside, clear out the liquidity at just above A, and then you are off to the races back to the downside. So that's something what we're anticipating. Next weekly, we don't really have anything above that, so I can take dailies and the weeklies off. Do we have anything on a monthly? Not really. We have a monthly down here at the 16,549. Interestingly enough, that's a point at which I'd be thinking about taking profit because it's a very, very strong key level, and there's other confluences around that point as well. Okay, let's just minimize the Fibonacci just so we can clear the chart a little bit. Now, one of the things that I like to do is to map out order blocks, or maybe looking at fair value gaps. Now you can see clearly, you know, I could use any kind of indicator to help me with this, like LuxAlgo is a fantastic tool for this, but realistically just being able to map these out yourself is good enough. I mean if you're looking for fair value gaps, what you're looking for, moreover on the longer time frames than the shorter time frames, is when you see, you know, a big impulsive move down like this, you need to identify the, you know, the point at which, so you can see here the, let me just zoom in just to make this nice and clear for anyone who wants to just be able to understand how to map out fair value gap. So you can see this is the candle I'm interested in, this big, you know, move to the downside here. Now I'm looking for the wick that preceded the candle, which is here. So we'll just mark that off. I'll try and make that a different color. Let's make it red to match the let's just get rid of that 1 second. My apologies. So let's make this red. Let's make it stand out. And let's just increase the color. Right, so you're looking at, you can see that that is right on the wick of the previous candle. And then what you do is you take the wick of the next candle, which is here, and then that's your fair value gap. Okay, so the distance in between these two is your fair value gap, right? That is where the prices has really came down really quickly, and orders and stuff like that haven't had a chance to see in this area how orders would be kind of respected. So what normally happens is the kind of algorithm for whether it's Bybit or whether it's Binance or whatever else, you know, there's an idea that the price will want to come back and fill in this area to accommodate any orders that missed out, you know, during this fast action move. So you normally always get a retest to come and test at least 50%. So what I always like to do is to take the average of that fair value gap. So that the average of that fair value gap is kind of just there. So I'm going to delete that. I'm going to delete that. And then I'm just going to put my text as FVG. I'll make it red to match the color, and then we're off to the races. Okay, so fair value gap. So that's an interesting area as well. Okay, now that's on the 4 hour. We also have an order block here, just at this zone. You can tell it's an order block. You can see the rejection where the price started to try to push up, and it's only a small one, but we've still got a, you know, good old order block there. We've also got another one just above. I mean, I'm not anticipating, if I'm honest, that the price is going to come, you know, anywhere close to here, but still, you know, it's a point on the chart where institutional investors, yeah, if the fair value gap is the algorithmic version of that, then the order block is more like the institutional and your hedge fund kind of teams who like to come and get them. So there's two fairly decent order blocks, and then you've got the huge order block up here, which again I'll just map it out for the sake of it, but I don't anticipate that coming, you know, anywhere close to where we need to go to. But we've got them marked on the chart. So then so then let's just overlay the Fibonacci retracement again. So we take this and we take that, and we can see again the fair value gap is not quite at the 0.5, but do we have any other confluence in that area? Weekly again is just below. Don't really have a daily in that area, so that's its own confluence in itself. You know, it's in between your 0.382 and it's also in between, you know, and your 0.5. So again, in terms of a liquidity grab, I mentioned that this 17,100 is a really key area. In actual fact, it could, you know, go a little bit beyond that and come up and take the take that fair value gap area, which is at 17,219. Okay, so just keep that in your in mind in terms of where price action might go. Other things, I'm just going to get rid of these. I don't want to mess up the chart too much. The other thing I like to look at is the pivot points. So pivot points are essentially a calculation that used to be before a lot of fancy pants technical indicators and coded indicators came out back in the days when it would be kind of people in the pit and trading is specifically on Forex is trying to figure out a range to work to for your next day or your next week or your next month. So what would be the range in which, I would be a high point or a low point, and then, where you could reverse from and things like that. So the way they'd calculate it is they would take, let's say you're working on a daily, they would take the daily level, right? So the previous candle, the previous day. So maybe the day is I don't know, Friday, and they want to take Monday's last data. If that was the last day's worth of data, they would take the high of that day, they would take the low value of that day, and then they would take the close value of that day. So that's 3 data points, and then they would divide that by 3, and that would be your pivot point for your next day. So if you were starting on the Monday, you'd have a pivot point for that day, and they would work out a support and resistance, and they would just simply they would take the pivot point. So you've just worked out your pivot point from your previous candle, and then what you would do is you would say, okay, well, you multiply the pivot point times 2, so you double it, and then you take off, if it was your resistance, you would take off, you would minus the high, and if it was the support level, you would do the same calculation, but you would minus the low of that value, so the low of the previous candle. So it gives you a range, so pivot point and a high and a low. So it's a standard thing. I mean, it's lots of people use it, and it's more for just identifying, where these things are. So I'm currently, if you take the pivot point, this is the weekly pivot point. If I put it on the monthly, this is just a standard indicator on TradingView. It's not a community one, so anyone can kind of use this. But if you take the monthly pivot is again really key point. So this is this pivot calculated for the start of January. So this is January's pivot point based on that calculation. So if you look at the range, right, that is the range. That's your resistance level 1. So the point at which you may get resistance. And it's not to say, by the way, in the month that it will hit this level. Absolutely not. It's just the range in which it can go to, and you would expect a reaction. And then you have your support level down here, and that's an interesting point. I mean, anyone in our server would have known, I've said a few times, I'm anticipating a move to 15,750, and we can see support level 1 is 15,700. So that's a key level just to mark off your charts, and that this is within the monthly range. So that's your pivot points. Now, this is looking at your monthly, but again, the important point to mention here is your pivot point. And again, why we're seeing so much difficulty is simply because, again, it's a pivot for the month. Now, if we take the weekly version of the pivot point, so this is to say, this is the whole range for your month. Okay, the month in which we start at the start of January, and then the next pivot range will be from the start of February, and each month you just calculate the previous month's candle, and then that'll give you your range. Now the month here is you can see that would be the expected or the anticipated move for the month, but you can actually go between S1 and S2 and R1 and R2, so we could go as high as here. To the converse, we could go as low as here. Usually, and this is like 80% of the time or something like that, you don't breach more than your R2 or your S2 levels in any time frame. So, if you take, this is the month, if we take the week as an example, so let's just change to the weekly. Okay, now the end of this week is kind of like now, right? So you can just see here, I'm just going to zoom in. So you can see the time frame has changed, the range has changed. So the pivot point for the week, which started last Monday, was at 16,645, and you can just see how well it was respected. We had a bit of a move to the upside, hit the pivot right at the point. We had a couple of wicks on a couple of 4-hour candles, but then we moved to the upside, and then whereabouts do we get sticky? Right at the resistance level 1 again, and this is resistance level 2. What usually happens more often than not is we never really in a period of time breach your R2 level. So just keep that in mind if you're ever trying to figure out roughly what to anticipate for the range, just as a guide. Like, so yeah, that's the pivot. The one I'm more interested in, obviously from our side, is that kind of monthly pivot. So at that 14, sorry, let me just change that back to monthly. Yeah, you see, we haven't quite hit the pivot for the month yet, but again, I could make more of a case that we could come up, just snag the pivot, maybe come up a bit higher, take the fair value gap out, and then we start to head down, and then you could almost start to think, well, how many areas of value do we have, or confluence, in terms of your fifth Elliott wave? Well, look, you can do a few things. Let's say, if I'm anticipating, let me just put my magnet tool back on really quick. Let's say I'm anticipating that I think maybe we will come up to the 0.5 or the fair value gap. I mean, we can argue about that, but let's just say the 0.5, right? So I'm just going to use the 0.5 as our potential retracement before we start to come to the downside. So let's say, well, I'm just going to mark that out on the chart, and I'm just going to say, let me take the magnet tool off. There's the 0.5 there. I'll mark that off. I'll just call this retracement liquidity. Okay, that's fine. And then we can get rid of our chart, our unit now. So that's the fair value gap there. I'm just going to make this a little bit less pronounced, so it's the same. And now what we want to see is, where realistically can we expect our third wave to go to, and do we get any further confluence down here? So we can say, well, we can take our retracement tool, right, and we can go from the high. Again, I'll just use my magnet tool here just to keep things nice and kind of spot on. And then we go from that top to the low. Yeah, so this was the low point, and then we go up to, well, we can do the fair value gap, or we can do the 0.5, and then it's about, well, do we get any confluence further down? So let's just say we do the 0.5. Okay, so what you're looking for normally for your third wave is your 1.618, right? It can go anywhere from your 1-to-1 to your 618 in realistic terms, but you then start to think, well, maybe if we want to utilize the range, so yeah, from your pivot range, let's just say over a month, this is the whole month worth of value. Theoretically, we could take our third wave, and maybe we could say, well, maybe S2 is where we anticipate the move to go to, and maybe S4 comes back up, which is your retracement or your corrective move, and then your wave 5, which would then go into another month, so it would be a new data set, and because the move would be down, the next data set would provide a much lower target for your move to the downside as your S. But you could see, again, everything is about mapping out a plan, right, and trying to anticipate where moves could eventually go to. But you could say maybe this comes back to the 618, maybe it comes back to S1, maybe not, maybe it just goes back to the 0.7. If this comes down, it could go to the 1-to-1. It could go all the way down to the 618. It's not infallible. It's not to say it won't do that. It's just we're trying to use the range, and if we anticipate that the move happens within a month, that it does happen here. So we just don't know yet. But it's about kind of creating that plan and utilizing TA to figure out where things might go. So as I say, that's the TA really. That's kind of what I think gives me confidence. We've anticipated where we think a move might come to the upside in terms of before we retrace back. Could be the fair value gap, could be the retracement level. We might just come up at this liquidity and take your weekly level here, and your daily level is also really close around here. I'm sorry for really looking, the chart's looking a little bit kind of crazy now, but you can see around these levels here. And we've not even looked at Bookmap, by the way. Bookmap might tell us another completely different story, but you're looking for confluence around these areas. So you've got your kind of your 17,100 area is a really strong area. You've got a daily, you've got a weekly, you've got a fair value gap just at that 17,219. I think in my DCAs I'm at 17,221, maybe 211. I can't remember off the top of my head. I'll have to double check. And then we've got the 0.5 up here at the 290 level, and then also we've got some further confluence up at these ranges. But if you are up at these ranges, really you don't want to look too much further than your order block area, which is just around that 17,500 mark. Again, nice whole half number to get your teeth into there. So I think we'll call it a day on this session. That's what we're anticipating for the next week. We're going to have another session in our server a bit later on, just on the week ahead in terms of the economic news. Looking forward to that. If you're not in the server, then maybe you should come along and get involved. It's a cool place to hang out and everything else. So I shall leave you guys in peace for now. Come and check out the promo, and then if you're in the server, I'll see you shortly. Bye for now.